It's all worth watching. You can't dismiss any particular risk, but the big change this year has been a move from a consistent trend in just about all the data we look at, moving higher, getting better. And this year, it's been choppier and less even. You see it in global growth patterns. You see it in different risk premiums in different marketplaces. You got corporate spreads widening, for example. But in other areas of the economy, we still see a lot of risk appetite. So you're getting a choppier thing here. We've moved from a significant overweight in the portfolios we manage to a less of an overweight, and we're looking to see what happens next. But you have to pay attention to all of these risks.
Yeah, David, it kind of sounds like where you're coming from in terms of being neutral on risk assets, although you point out that being neutral is not the same as being bearish.
Yeah, exactly. It's a pretty similar position. I think the bull market remains intact. We have very strong corporate fundamentals on the one hand. Profit growth has been some of the best in the last several years. Revenue growth is really what's driving it. And companies are responding by opening up their purse strings and reinvesting in their businesses. All good signs. Forward indicators are suggesting that this momentum will continue. But as we've been talking about, there are some risks out there. The biggest one we're watching is trade, and we could see an escalation of the trade tensions. So we think a more balanced approach in portfolios makes sense, especially with U.S. markets relatively close to all-time highs.
And David, to that point, everything we're seeing in terms of the risks around trade, this weakening of emerging market currencies against the dollar in recent days, how much of a risk is a stronger dollar to the markets here in the U.S. and equities?
It's one of the factors that is a risk. I don't think it matters too much for corporate profits. U.S. companies have obviously some exposure to a stronger dollar, but it's really more of I think, a signaling question about how much does a strong dollar then lead to a reduction in growth in some of the overseas markets. So it's definitely something we're watching closely. And that being said, the dollar looks pretty expensive, and the scope for a significant appreciation in the dollar from here seems limited. So I think the risk is fairly low, but it is one of the risk factors that we're watching.
Kevin, what does it take to scare the U.S. equity markets? I mean, if it's not a trade war, it's not a bubbling up emerging market crisis, what is it out there? And what do you attribute this sort of underlying bid of buy the bad news and climb the wall of worry to?
Well, the second part of your question is easy. David just hit it on the head. You have revenue, not earnings. Earnings are up 20% or something for the S&P, but revenue is up 10%, and it's not because of buybacks. It's because of strength in the overall economy. So the main reason that stocks have advanced over the last 2 years has been a re-enlivened growth posture. And as you look forward from where we are, we're still seeing some very good signs of growth. But the tail risks are always the things you got to be concerned about. So when you look at Turkey in itself is not particularly an issue, except that it's an example of the same kind of issues that other emerging markets may have down the road. You've had a lot of emerging markets pursue growth at any cost through an investment-led growth model with insufficient savings and now have led to too much debt in their system. That is a problem. It's a risk, hard to quantify, but those are the kind of things that could tip the balance here. So you have to watch them carefully.